Bob Michele, the chief investment officer of JPMorgan Asset Management, has warned of an economic downturn, saying that markets are headed for a rally before an inevitable slowdown. In an interview with Bloomberg on Friday, Michele says risk assets will rise in the next quarter as they did during the Great Recession.
In the next quarter, we could see risk assets rally. You could have a feel-good period and then the reality catches up, Michele said.
If we've been taught anything this month, you may see it coming, and you may not. You don't know exactly where it's going to hit. But once it hits, whatever you own, you own. During the interview, Michele anticipates that the central bank may cut starting in September. He said many investors, including himself, are now sanitizing their portfolios so that they only have assets that can weather or thrive in an economic downturn. Michele advised investors to avoid leaning into the rally, as gains will be fleeting, adding that the U.S. will enter a recession by year-end. "We think the recession is inevitable by the end of the year," he said. Having been an investor through the financial crisis and looking at that seminal moment when Bear Stearns and JPMorgan Nice,
JP combined, the next quarter was great for markets.
Equities went up 15% to 20%, Michele said. High-yield credit spreads retraced a quarter, and the bottom fell out. When the pain hits, when we get into a recession, we're expecting high-yield credit spreads to go to a minimum of 800 basis points over comparable U.S. Treasuries, he said during the interview. Defaults can get up to around 6%. I did 5 client calls yesterday, and all of them were about what do we own in our portfolios, Michele said. I want to use the next quarter to comb through our portfolios and ensure we have the best quality borrowers. Last month, Michele was quoted saying that a recession is likely and that the best investment strategy is to stick to high-quality bonds. He predicted that the whole Treasury yield curve would come down to as low as 3% by August. Meanwhile, Morgan Stanley chief US equity strategist and CIO, Mike Wilson, reportedly said, "The bond market is effectively pricing some sort of a recession at this point, while the equity market is still in denial. When the yield curve goes negative, it has high predictability that a recession will be coming within 12 months.
But 12 months is a long time. The real trouble starts when the yield curve re-steepens."
Because that's essentially the bond market saying the Fed's going to have to be cutting here at some point, Wilson told Bloomberg TV. Price action. Yield on 2-year Treasury notes fell from over 5% levels seen in early March to as low as 38% last week in the backdrop of the banking crisis in the U.S., as the shuttering down of the Silicon Valley Bank led investors to rush into the safety of short-term treasuries. The yield on the notes has risen back to 3.96% at the time of writing. The yield curve has bull steepened by 60 BPS in a matter of days, something seen only a few times in history, and usually the bond market's way of saying recession risk is now more elevated. Morgan Stanley analysts led by Wilson wrote in a note, "Markets witnessed significant bouts of volatility over the last 2 weeks, following the unfolding of the crisis which many feared would end up in contagion. However, following UBS Group AG's rescue deal announcement of Credit Suisse Group AG, as well as the coordinated action by central banks around the world to boost liquidity, major Wall Street indices witnessed some bit of relief.
The SPDR S&P 500 ETF Trust SPY closed 0.96% higher, and the Invesco QQQ True Trust Series 1 gained 0.35%. The Vanguard Total Bond Market Index Fund ETF closed 0.43% lower. Market participants are now eyeing the Federal Reserve's 2-day policy meeting that starts on Tuesday.
The ACME FedWatch tool shows over 73% probability of a 25 BPS rate hike during this policy compared to over 26% chance of status quo. The big question is, are we in a recession? Will the Fed pivot? Let us know your thoughts in the comments section. Thanks for watching our video. We hope you found it helpful and informative. We would love to hear your thoughts, so please leave a comment below and let us know what you think. If you found this video helpful, please give it a thumbs up and consider subscribing to our channel for more content like this. And don't forget to hit the notification bell to be notified when we upload new videos. Thanks again for watching, and we'll see you in the next one.